Apple used to be the most valuable company in the entire world. However, there are just more innovative tech companies out there, especially those linked to AI, and the distance between Apple and, for example, Microsoft is only going to grow further and further. For example, the AI services field, the total addressable market share is expected to grow 30% per year. And that does not include other exciting fields such as online cloud computing, which is a fancy name of saying online storage, security, and analytics. Let's take the cloud business of Microsoft, which includes a little bit of AI. That currently makes $75 billion of yearly revenue. They also own 49% of OpenAI's ChatGPT, and if we apply the expected growth rates for all of those industries through to 2035, just those businesses alone of Microsoft are expected to overtake Apple's entire business. And the real slap in the face is that only includes 32% of Microsoft's current total revenue. So 1/3 of Microsoft's business is going to overtake the full Apple empire. It's not really that surprising considering Apple's most important business segments, which include the Apple iPhone. The smartphone market is only projected to grow 5.7% each year for the next 8 years. And the second most important category, which is personal computing and laptops, that's only growing around 4 to 5% per year. The failure of Apple to establish brand new, high growth, innovative business segments over the past 5 years is really starting to scare away investors. Berkshire Hathaway, the largest single investor in Apple, has already started dumping their shares. They have already sold around 3/4 of all of their Apple holdings over the last 2 years. Even with the best investor already starting their exit, Apple still today maintains a high valuation, which actually means it's got further room to move lower. To calculate the total valuation of any company, all we do is we take the yearly profits the company makes and multiply it by a PE ratio, the price you're willing to pay per dollar of profit. Apple's 12-month forward PE ratio, which is kind of the rule of thumb of how investors look at stocks, that is sitting at a 28. If we take into account Apple's expected profit growth of that 7%, then a 28 forward PE ratio is extremely expensive. It should be sitting closer to about 20. In other words, Apple's stock price should be falling around 40% from today's levels. But the market doesn't work like that. It's not run by mathematicians. It's run by greedy bankers and investors and Wall Street who have bigger egos than they do brains. And what happens to a company with extremely high valuations paired with slower growth over time? We usually see what's called a pullback in time, or a pit. My case study to explain how this happens is looking at Walmart from 2008 through to 2012. Walmart during the Great Recession was seen as a safe haven. People could park their money to avoid the catastrophe in the economy. Even though Walmart's stock price did fall 20% from 2008 through to 2009, many other companies lost 50 to 80% or just went bankrupt. However, Walmart's valuation at the peak was around a 20p ratio, which actually isn't that expensive, and it's roughly double that in today's market. But back then, the average company was only valued at around a PE of 13. That made Walmart around 54% overvalued against the rest of the stock market in around 2009. And when you're a company that's extremely overvalued and your profits are not growing that fast, all that really means is your stock price is unlikely to grow. And in Walmart's case, they failed to grow their stock price for around 4 years. And that's in direct contrast against many other companies who are rebounding strongly, increasing 100, 200% after the GFC. The only way that Apple could avoid this pit or pullback in time is to become truly innovative, to create new business segments that grow 30, 40, 50% in a year. If they can't do that, then the business is going to go into a slow decline. Ever since Steve Jobs passed away, the track record of Apple successfully innovating brand new business segments has just been one of the worst on Wall Street. In 2014, Apple quietly launched Project Titan, a secret team of engineers and designers who were tasked with building the Apple car. The idea was pretty bold, creating a self-driving electric car that would do for cars what the iPhone did for phones. Apple had 1,000 employees working on this car project and had a total bill of around $10 billion. They poached talent from Tesla, Ford, and Mercedes to try and get the job done. However, after 2 years and without strong leadership, there was a power struggle about what should we focus on, the self-driving aspect of the car or just having lots of software and features inside of it. After 4 years, Apple pretty much gave up. They were only able to make 66 self-driving cars, and in terms of driving the car, a safety driver had to take over on average once every mile. In direct competition, Google's Waymo was driving thousands of miles without a driver having to intervene. Meanwhile, in terms of electric cars, Tesla established themselves as the number one. The next failed adventure was the Apple Vision Pro, which was a headset released back in 2024. Apple marketed this product as the most advanced personal computer ever. However, Apple didn't just launch a headset, it launched a headset that costed more than a MacBook, an iPhone, and an iPad combined at $3,500. That was 7 times the price of the Meta Quest 3. Not only was the price thousands above competitors, they also just had a different focus. So Meta was focusing on gaming, and buying that for $500 kind of makes sense. However, Apple was looking at production, movies, and FaceTime, almost more of a business aspect. However, buying a $3,500 headset just so you could have a 3D interview with someone maybe overseas is just not that enticing when you can just look at a person and talk on a screen. If you have ever worked in a professional office, you might have heard something called ergonomics, which is actually training around safety in making sure you don't sit uncomfortably for many hours. Personally, coming from a family of fruit blockers growing up and seeing my parents dig irrigation trenches by hand, having bad ergonomics is kind of a way of saying you're just a little bitch. But overall, the Vision Pro is a true ergonomics disaster. Weighing around 600 grams or just under a pound, the Vision Pro is just too heavy to have on your face. They were looking to sell around 1 million of these headsets in the first year. However, the true number was around 400 to 500,000. And whenever your sales are at half or below of your expectations, that to me says you probably made a loss on that product. Analysts say in terms of AI, Apple is around 2 years behind competitors, but that time might actually be worse because they're not willing to spend the money. Apple's crown jewel should have been Siri, a talkative AI experience where you just speak to your phone and you can have it just do pretty much just what AI does today. For example, just listing some AI features that are pretty insane really, that Apple AI cannot do but others can. We have real-time voice translation of different languages. You have proactive searches now where you don't even need to type in what you want, you just get suggested things that suit what you need. You have AI-powered photography enhancement, changing of backgrounds, or just fully AI-produced images and video. AI assistants can now build in your finances and your logistics. For example, you could just say what you need into your phone and computer, maybe for a small business, and AI assistants can now go off and order and deliver those products straight to your door. Apple could have spent their money on some Apple AI. All of those features I just listed, you could have bought that for maybe $50 a month, enhanced Apple AI, and do all of that on your Apple iPhone. However, Apple has underspent in terms of AI hardware. They only have around 50,000 old GPUs, and each year GPUs for AI are getting around 4 times to 10 times more efficient. If we compare that to the hundreds of thousands of units that have been bought and deployed by Microsoft, Meta, and Google, and this has led to Apple fully giving up on developing their own AI. They've reportedly tried to train their own models through Google Cloud, so that's just giving up on doing it themselves. They are now making deals with OpenAI with ChatGPT features just on Apple products inbuilt. It's kind of like the App Store on Apple products. They don't really make most of the apps and the features that are sold on there. They just take 30% of all revenue made on Apple's products. They're probably going to do the same when it comes to AI. But we can dive even deeper into this Apple tax idea. It is a fantastic business model and it's extremely lucrative. This Apple tax on the App Store brings in $20 billion alone, and that translates to some of the highest profit margin money in the entire world, because Apple doesn't need to innovate and create apps, it just sells them on their store. However, one of the best innovations, the Apple tax, is actually potentially going away. In August of 2020, Epic Games, which is the founder of Fortnite, really got sick of Apple taking their 30% slice of all in-game purchases. Fortnite gave players a way of spending money outside the Apple ecosystem. However, Apple took Epic Games to court and actually nearly won the entire case. They only lost one charge in court, and that was a ruling about developers being able to link to outside payments, and the precedent of big tech maintaining their monopolies and taking 20-30% chunks of business revenues is actually changing drastically. As of June of 2025, Apple now must allow different developers alternative pathways in terms of payments. What that means is you can fully dodge now that Apple 30% tax. All developers have to do now is come up with their own billing techniques. This could just be the beginning of the collapse of a really good profit margin business for Apple. Due to these failed innovations, as you just saw, and the demand from investors and Wall Street to continue seeing quarterly growth every single quarter, Apple has been forced to squeeze more and more money out of its customers. When the first iPhone was launched in 2007, it came with a charger, a cable, and a pair of wired earphones. Even Mac and MacBook computers came with spare chargers and extra cords and adapters. What? And that's the cherry on the cake for Apple. Their products already felt premium and better than the rest of the market, and therefore you didn't mind paying 20-30% more than competitors. However, over time, competition, mainly from Android, has meant that the products are actually very similar in quality or even better, and all Apple has really done is started to charge money for the things they used to give away for free. For example, in 2016, that's when Apple fully removed the headphone jack from the iPhone 7, and that forced people to use wireless AirPods. At the same time, Apple first launched their AirPods, which were being charged at $159. By 2022, Apple AirPods were now generating over $12 billion in revenue. The business alone would have been worth more than entire companies like Spotify or Adobe at that time. Another example are the chargers. Now, Apple uses charging bricks, and in 2020, they stopped giving those out for free. You now had to buy those for $19 or $29, depending on the speed. Even the iPhone itself is squeezing more and more money out of customers, far outpacing inflation. From 2007 through to 2017, the price of iPhones doubled, meaning inflation of 100%. However, the broad American inflation rate only went up 18%. Moving on to the PC space, yeah, you can get a starting Mac at around $2,000, but you can upgrade that to over a $12,000 cost. But the funniest case is actually to do with their monitors, to do with their Mac towers. Back in 2019, Apple attempted to sell a monitor and stand combo for a combined $6,000. If we inflate that to 2025's money, that's $9,000. And that's not even including the PC tower, the actual computing hardware. That's just your screen. However, Apple customers seem to enjoy the torture with 90% loyalty rates, meaning if you bought an Apple iPhone or product, you're going to again buy another Apple. Therefore, after everything we have discussed today about Apple doing a fundamental analysis of the business, it just has failed to meet the standards of the growth on sale portfolio, which has now returned 12.8% in the last 3 months. If you have enjoyed today's video, I've got 2 more for you to watch on the screen. See you there, guys.